so that we're able to also give ample time for, open discussions, because I think that also will build us.
Okay.
So good evening once more, right?
Yep.
Yes, Coach?
Yes, I'm just saying the recording is on.
Okay.
All right.
Thank you.
Mm-hmm.
All right. So today, traders, we want to discuss something that is fundamental, that is almost like a building block that you must master to do for you to be able to trade successfully. It's a very simple strategy, but simple does not mean easy. Some people do not know actually how to set support and resistance. And actually, some people say you set it on the wicks, some people say you set it on the body. But really, what you really need to understand that these are zones, they are trading zones. Just like coach usually says, they're like a boundary of a country. Like if today you are to go between the border of Kenya and Somalia, there's no straight line that shows that this is the border. But generally, it is believed and understood that this buffer zone or this zone marks, the end of Kenya, and now you're entering Somalia. So it's the same thing. So that when you're trading and you're approaching the zone, if let's say you're on a frenzy, like you're really buying, then you start to slow down because probably the market is about to turn. So as long as you're trading within the zones, and you see the market will always move between zones. As long as you're trading within zones, and as it approaches, let's say it was moving from, it was rising up, going up. As it approaches the roof, which we call the resistance, and you are buying, then you start to slow down because chances are it might, stay there a while before it decides to continue or go back down. So it's very important for you to understand this simple concept, but simple does not mean that it's easy. So let's go. Simple definitions of the things we'll discuss today. So we will, as usual, go through just 2 or 3 definitions, and then I'll show you on the chart how to do this. And then this is something that you can practice in any currency pair. It doesn't really matter. And then you'll check, you can back test and see whether it's actually respecting the zones that you've marked. So support in Forex occurs when falling prices stop, change direction, and begin to rise. As you can see on my chart here, you see the price here was coming, then it was falling, and then it's going up, falling, and then when it reached here, this is an area of support. It's like a flow of your house. It bounced and then went up, and then as usual, normally it retests. So you see it come back and bounce again, and then it goes back up. So this marks your area of support. And I'll show you in the chart, once you mark your support properly, then the market always tends to obey it. Always tends to obey it. And as you can see, around your support area, you can begin to see the other things that we've also learned in other previous classes. Like for instance, a telltale sign that this market is turning, you can already see look at the 3 candles, around here. If you look at the 3 candles, these ones, then as you usually learn from the other class, the first one will be the measuring candle, and then the apex, and then the trigger. So that will always show you that these are stand. And then of course it comes and retests, and then it goes back on its way up. So this marks an area of support. it's like a floor. Think about it as the floor, which supports or holds the prices. So literally what happens is the market will always come down and bounce back up. So that marks the area of support. All right. Now, similarly, resistance is now almost like the opposite. It's like the roof of your house. So when prices are rising, normally they get to a level in which they stop and then they change direction and begin to fall. So in this particular case, the example that you're seeing here, you did not have the benefit to see this other bit. It's cut. So the prices were coming up, and then when they get here, they hit this zone, and then they begin to show signs of turning back. You see, again it retests, and then now it falls back down, as you can see. So in this case, if you are buying, you are buying. As you approach this zone, you begin to slow down. You slow down, because the market is about to turn. And then you can also confirm that with the other telltale signs. You look at the 3-bar reversal. You look at the candles, they'll start showing you the signs. You look at your measuring candle, you look at your apex and the trigger. And then now, if let's say you are buying and then you start seeing these signs, maybe you start changing your strategy. So instead of buying, you start selling. And then now when the prices fall, you take profit, you're in profit. So this area marks a resistance zones. So any rising price will always come here, hit and fall back down. So I want to jump straight to the charts and show you. And if you follow this simple strategy, then you'll be a very happy trader, as you can see on this coin over here. The pips will just be coming. Just give me 2 minutes. I want to jump to the charts, show you how to set them up, and then I'll open the floor for questions and answers. All right, I hope you can see my chart. So this is what we are calling naked Forex. As you can see, it's just plain chart, no indicators, no, it's a very clean chart. It's just the bare price action, you're just seeing the chart and the market. So what happens ordinarily to look something like this? So the first thing that you do, you go to a higher time frame. This is a Euro Japanese yen, and my time frame here is day. So you look at it. Then for you to be able to set up the support and resistance zone, you zoom out. You zoom out. So you can zoom out by pressing, if you're on a C trader, the minus sign on your keyboard, or you can right click and come here and you see basically move. So now I've zoomed out, to almost like 3 levels below, and it gives me a chance to, have a very good view of the charts. So what you do, without thinking too much, you just look at significant turnings of the market. So you come to your tools, you look at the horizontal line, you pick, and then you just place it where you're seeing a significant turn. Like, without thinking much, like here, I've not even thought, but you look at, if I place this line here, is it touching is the market touching the line several times? Right? So if you feel like that is the case, then you leave the line there. In my case, I usually like colorful lines. So let's use green, and then you can even increase the thickness of the line. The good thing with this tool, you can so that you don't keep choosing the line and also choosing the depth, you can always duplicate the line that you have done. In this case, I'm just going to hit duplicate, and then I'm going to look at the next zone. In this case, because this is daily, I want to mark at the last high that I'm seeing here, that I can see that it touched several times, and that's here. And then I'll duplicate again, and then mark the lowest point I can see without thinking much. Duplicate again, and then I'm going to just put it where I see significant turning and where it's touching several times. Yeah. And then again, without thinking too much, I put it again where I see that it's touching several times. And then I think just one more. Somewhere there, it's touching several times. You don't have to be very accurate because it's a zone. So then you move to a lower time frame. So I'm moving from day. Let's see what happens in the 4-hour. As you can see, most of the time, even in the lower time frame, it will obey the zones that I've already marked. So let's look at the 1 hour. So in the 1 hour, I want to add a few more where I'm seeing that it's touching on most zones. Let's say like somewhere here. Again, without thinking too much. Down here. And somewhere here. And then let's look at, for me, most of my trades when I'm scalping, I take them in the 1 minute, but I use the 1 hour, 5 minutes, and the 1 minute to give me direction. So let's put our last zones in the 5 minute because that is one of the ones that we're using to give us direction. So as you can see here, I'm just going to add a few more zones with the highest here, where there's a significant turning in the market. Here is significant. All right, you don't have to be very accurate, but the areas where you're seeing a lot of, that the market came and actually turned. The market came and turned. So now if we go to the area that we normally trade, if I zoom in and actually even go back, and let's say we're even doing a back testing, this is now on the 1 minute. On my 1 minute, you can see that it always respects those zones that I've marked, that when the market comes there, it either pauses or touches and turns down. Like you can see in this particular instance, it was playing around here, and then it came down. When it came here, just look, bang, and then it went back up. And I can show you this even on a different currency pair. There's one that I was trading on during the day. This the Euro USD. Look at the Euro USD, my support and resistance zones. So this is I've gone back way back to July 23rd. So if I advance this charts one bar at a time, look, just see the way it's respecting. It goes, it goes, it goes. It always respects those zones that I have marked. It respects those zones that I have marked. Look, as I keep going. So in this particular instance, you can see that it's coming like this, going up, it comes here, resistance, comes down, support, resistance. So you can always, so when you're trading, it becomes very easy for you then that when it's coming down, like in this particular case, assume you didn't have the benefit of, looking at this area. So if the market is coming and you have seen here, it's already showing signs of hitting, then you can start placing your buy orders, because this is a support. This is a support zone, and almost without fail, it will always go up. You see, it goes up, and you take your profit. Again, as it hits the level of resistance, when you're somewhere here, you slow down on your buys, and then probably start taking your sells. And then when the market turns, because it will always turn, it will take your profit. And this zone, this is a higher time frame. This is 4 hours. If you look at between this resistance and support, this is about 162 pips. So this is enough. If you go to a lower time frame, this is enough trading opportunities if you are a scalper. Again, let's keep advancing. You see that it always respects the zones that you mark. And once you get, you practice this often and you get good, you don't have to be marking it all the time. You can do it once a week, on a quiet Saturday, on a weekend, because the market will always repeat what it has done. As I'd shown you, this was way back from July. Look at now. And this is Euro USD. Even with the spikes that we have been seeing recently in the market, it tends to still play around the zones. You see. So today it came. If you're marking this as zones, then today it was basically in zone A, and then it came to zone B, and now it's in zone C. So you trade within this area. So you trade here, then you trade here, then you also trade you trade here over this period of time. So ladies and gentlemen, traders, this is how you, when you get this right, how to put your support and resistance, then you are halfway done in your trading setup. So the rest is just, if it is going up, place your buy orders. If it is going down, put your sells. And you'll find that then your trading becomes very easy, because you're trading within the zones and you're not just putting haphazard buys and or haphazard sells. So thank you very much. I'm going to now stop sharing my screen, and I'm going to allow for an open discussion for questions, and an open session for you to ask questions. Thank you very much. The floor is open.
I have a question.
Yes.
This is Brian from Kenya, and I wanted to ask, can you please demonstrate to me how you can use Fibonacci retracement tool?
All right, that's a good question. So,
Can I answer that?
yes.
First, the Fibonacci retracement tool is a tool you use. You use majorly when you want to have an idea on its own. It is not very, how do I put it? It is when you use indicators, you have to use several of them to confirm confluence. In other words, I'm saying you need to use many tools to actually show that the market is right. Okay, so by itself, it's a very powerful one. But what it does sometimes without confluence, then it's not like 100%. More of fact, there's no indicator that's 100%. However, to use it, let me open up in chart. You basically need to get to your high and low. That's what you do. And then you drag it from the last high to the last low. So whichever way the market is going. I'm assuming you can see what I'm putting here, right? New? Can you guys see that? Hello?
I don't see it.
Yeah, hi.
It's not showing.
Oh, nothing is showing.
The screen has an issue, like
Ooh.
there are many things open. So
Oh, okay. Let me. Okay. I guess I do have minutes. All right. Anyway, but I'll keep closing other things. But in general, what you need to know about Fibonacci, even though we are not talking about Fibonacci today, to set up Fibonacci, you have to go to a high, the last high, and then you move it to the last low. Okay? And essentially, what you do is you use that as a ruler. Once you place it from your last high to last low, using the bodies, then the market is said to respect certain numbers in the market. For example, the 65, 61, 50, 32. Okay. But does it mean that it uses it 100%? No, the answer is no. But sometimes you can use it with confluence with other instruments. Okay. So let me see if I can share again. Can you see now?
Yes, yes.
We can.
Okay. All right. So then you come here and you get the tool, Fibonacci. Okay. So there's Fibonacci retracement, and then there's just the fan and the arc, depending on which. So the retracement is you're trying to ask yourself if this was the last high, okay? If the market was to go back to retrace, would it come back there? That's the question. So it doesn't matter whether you put it up there or you put it down. But in general principle, if the market is going down, it might be if it's a downtrend, you want to check how far it will retrace. So I come here, I place this here, and then I expand it to the last low, which is there. So remember, it's body, the last high body, the last low. So this is the point right here and there. Let me see if I can mark it. So it's this point here to the last body over there. So you just place it to touch that there, and then at the bottom there, and then you stretch it. Once you place it and then you stretch it, and then it just stretches and gives these lines. Now, those lines, they're not all significant. The only significant ones are like 61.8. Well, I mean, they said in theory they're all significant. There's 23, and then there is 50, 50. Okay, then there's I think 80. But
Excuse me, Tom.
wait. Okay, go ahead.
Please repeat again. I had network issues.
All right. To place the Fibonacci, you have to identify your last high and your last low. Okay, and then you take your tool, which in this case we have just placed it right now. All right. But anyway, I'm trying to undo it. So you take the tool and then you are able to stretch it from the last high to the last low. Okay. Then ideally what it does or what it is used for is used to tell you if this market is to retrace. By retracing, you're saying if it's to go up, it just comes from up, come down, and then the tool can help you figure out significant areas along its retracement path if it is to retrace itself. Now, the significant areas usually, whereas it can retrace itself all the way 100%, uh, most of the time it will only respect certain areas. And those are popularly known as significant areas like 23, then 61, okay, 61%. And then usually from there, the general one is 100. Okay? But of significance to this is many times you'll find that support and resistance, that you've just been learning about now, will also coincide with what you see with the support and resistance. So that you find, for example, 23%, or even at 0% here, it might coincide with something there. 23% might coincide with the last high, and so on and so on and so on. So usually the significance of using the Fibonacci is just to have a second opinion. So that, for example, here you find 23 point something, and that's where these green candles actually start. Okay? And then if you look back again at 61.8, 61.8 around here, you find that there was a significant point, the turning point right there. Okay. So let me see if I can close this and have another one. But now, in conjunction with support and resistance, the power of support and resistance come in handy, especially when you have, okay, like in this case, a Fibonacci tool. Okay, like this is a good example. Okay, so we'll see if we didn't know all this on the right hand side, right from here, we didn't know this, and we had to ask ourselves, well, we think this market might come back. How far will it come back? We don't know, right? But if we had marked here support and resistance, the Fibonacci tool will almost trace the same. So come here, get to right here. Okay, you take the last high on the body, not on the wick. The last low of the body, not of the wick. Last low of the body, which is there. Okay, and then you look at your significant lines or points. Okay, again, they say if the market comes up and breaks this 61.8, okay, especially like if it's coming from down, retracing its way back to 100%, if you break the 61.8, chances are it might go all the way down, all the way, and vice versa. If it's coming from up and it passes the 61%, chances are it might go all the way down. All right. Now, does it mean that actually it does? Well, there's no guarantee. It is just a second confirmation or second hint, not confirmation, hint. So the power of this only comes in if this coincides with the support and resistance. So support and resistance is still king. King in the sense that it is what you see. It is what you see. The Fibonacci and all these moving averages are what we call secondary confirmation tools. Do we need it? Absolutely no. Can I use it? Yes. Is it important? Will my trade fail if I don't use it? No. Okay. Just like saying the moving average. The moving average will kind of sometimes, if it coincides with the support and resistance, then you see its power. Otherwise, you don't need it. So what we are training you in this group, we are giving you a more powerful way of trading Forex to depend on what you see in the chart to avoid the reliance on tools. Just like I remember when high school, we used to use mathematical set. So the mathematical set would tell you averagely the angles, 45 degrees, 60 degrees, 90 degrees. But do you actually need them? The answer is no. I mean, you can use it to confirm it, but you can look at an angle and say, this is like 30 degrees. This is like 40 degrees. So which is better? Is it better to have your mathematical set where you can be using it all the time? Or is it better to learn how to use the mathematical set in your head? So you can look at the angle and say, eyeballing, this is like 30 degrees or 60 degrees. Okay? So anyway, back to the class. Sorry.
Tom.
Yep. Was somebody asking a question?
Hello, good evening, Coach Tom.
Yeah, good evening.
Yeah, this is Amanya Lusaka.
Yes, Amanya, how are you?
All right, sir. My question is about how can one possibly trade in a fundamental way in conjunction with charts and the candlesticks? Because something was it yesterday or before yesterday? It happened when all of a sudden you're trading and you have your resistance, support. Then all of a sudden, some certain candles come from nowhere because we are not sometimes informed about the news or USD. Or because when I went to check, sometimes then I found that there was something like opaque news, things like that. Then they come, they draw it just a candle. All of a sudden, you see your stop loss is triggered. So I don't know. Should we be looking out for news?
Okay, the answer to that is yes. You can look out for news, but for now, try to avoid to trade during the news. Why? Because trading the news requires a lot more understanding, not just of the fundamentals. The fundamental is essentially the news, the dynamics of the market, what's going on in the US, in Europe, and so on. And trust me, sometimes it can be very messy, and it's a lot of guesswork. It's like shooting in the dark. It's like blindfolding yourself and playing darts. Okay, you're blindfolded first, and then you have the darts, and you're trying to play in the dark. So trying to trade the news is very risky. You don't know the dynamics, you don't know what's going on. Okay, and at best, people who trade the news trade on hypothesis or basically assumptions. Assumptions. All right, that is what they do. So for me, for you guys, for now, my advice is be checking the calendar on a daily basis at forexfactory.com. Okay. When you see there's going to be a red flag like news happening, then on that day, at that time, you avoid the market. Because if you don't, the markets will be very, very volatile and you might lose your trades. Okay. However, if you must learn it, the strategy to use when you're trading the news is very similar the sniper trading we teach in this forum. So, but that can be a discussion for another day. So for now, my advice, keep away from it. Okay? Check the news, forexfactory.com, keep away from it.
Okay, coach.
Yes.
Yeah, I just wanted, I think I need some guidance. I've noted that I've been trading the 15 minutes. I've been placing my trades using 15 minutes. The 4 hour then I analyze 1 hour, and then I use 15 minutes to trade.
Yes.
I'm just wondering whether that the 15 minutes is the appropriate one for scalping, because I think within 15 minutes there's a lot that is happening. And something tells me that it may not be the best to use for scalping. I don't know what advice you'd give.
Okay. Your gut feeling is right. Okay. You have to make up your mind whether you're scalping or just trading, the regular trades, other strategies. So we do know that our sniper strategies, sometimes we set them up for 30 minutes, sometimes we set them up for 15 minutes. Okay? Essentially, we know the market will move, and we're saying when it moves, we want to get into that market. Okay? So at 15 minutes or 30 minutes, that the dynamics or the mechanics are quite different from the scalping. Scalping essentially means in and out several times in the market, and you're out. Of course, it's very tempting to do 15 minutes. You try scalping there, but then chances are it might not be as quick. The opportunities will not be as many as you have them in the lower time frame. So my suggestion is, if you want to scalp, then you come down to a lower time frame. The best is the 1 minute, because you get opportunities every minute. Well, if you can't do 1 minute, try 5 minutes. Use 30 minutes as your guide to show you the direction. Okay, but then you trade 5 minutes. Now, that is a little slower than the 1 minute, but definitely for scalping, that is better than 15 minutes. Now, 15 minutes, for most of us who are scalpers, will find that very slow. Okay. The one thing that I've been thinking of doing, which I'm still debating, is to help set up higher time frame for your trades, which means to take longer trades. So we can analyze using daily, 4-hour, and then take 1-hour trades. The problem with that, okay, well, one, that has a higher or better accuracy than the 15 minutes. However, the problem with it is that the market, the trades you take might not close for a few days, might not close within the day, might not close maybe for a day or 2.5, especially if you end up doing the 4-hour. But 1 hour, I think 8 hours, 24 hours, then it might close. And if we do that, my advice usually is when you're learning, try not to let your trades run overnight, because you don't know what's going to happen. That's the Asian market. So I don't know if I've answered your question, but yeah, that's the idea.
Understood. Thank you.
Thank you.
Yes, Coach Tom, sorry, I'm back. It's Amanya.
Yes, Amon.
Yeah, since you have just said that when you're trading, when you make analysis in a bigger time frame, it gives much more better accurate information. Why don't someone maybe why don't someone learn how to make analysis for 1 hour time frame, so that you can confirm if it's taking this direction, so that maybe whenever you're scalping, at least you have some edge of confidence.
So what is your question again?
My question is like, just like you have just said that when you try to make analysis for trades that are running in bigger time frames, how about one learns how to make analysis for those big time frames, then so that maybe you know that this market will be falling or this market will be rising, so that at least you stand some edge whenever you're scalping, at least you stand some edge of confidence.
Okay.
That
Two
it's falling or
things.
rising.
Two things. The principle of what I teach is the same and can be used or transposed to any other time frame. Whatever you do on a smaller time frame, especially sniper strategy, can be used in a higher time frame. So please don't wait for me to tell you how to do it, because we keep going through this every day, even in the videos, and we keep repeating. If you're going to be trading this time frame, use a higher time frame to check confluence and so on and so on and so on. Now, eventually, remember, you guys are like small eagles. At some point, I have to start picking you guys one by one and drop you out in the air. Not to kill you, but then you have to start learning how to flap your wings. You have to start learning how to actually fly. You have to start learning how to feed yourself. Okay? Right now, what I'm doing is I'm giving you the basics. I'm telling you, on a smaller time frame, this is what we do. On a bigger time frame, it's the same idea. Same idea. Now, why do I always insist on small